selling off this year.
Yeah, absolutely. I think the luxury sector has been selling off on China concern, obviously, and I'm afraid China concern will remain because as long as China keeps its zero COVID policy, it's unlikely to experience a substantial recovery in the economy. It's going to sort of on and off with many false starts, I'm afraid. We've seen numbers this morning showing activity under substantial pressure. As far as the results are concerned, this earnings season is absolutely key because so far, what we've experienced in this bear market, and that's absolutely unprecedented in the last century, never happened. We've had a 25% decline in US indices, entirely driven by the adjustment of the cost of capital, interest rates. So far, earnings have not been revised. So we're discounting the same earnings stream at a higher rate, and hence the 25% decline on stocks. So it's absolutely crucial, and investors will watch the earnings seasons with a lot of scrutiny for clues as to where profitability might go going forward.
Note, was there anything in the bank earnings so far from JP Morgan, Morgan Stanley that gives you a sense about the extent of any downturn that we're facing?
My understanding is not really. The most interesting part is the very gloomy headlines on these earnings. The spin of the commentators has been quite negative. I think the capital market revenue declines are largely to be expected given the current situation in markets. When it comes to lending, lending was still solid. Admittedly, JP increased provision. That's probably prudent given the current uncertainties. But there's nothing really that was so bad in these earnings. And actually, stocks having been under pressure year to date didn't react much over the entire session yesterday.
Very good morning to you, sir. How is liquidity looking in both the markets and indeed in the broader economy as well? As we were discussing on the show, and I know you've looked at a lot yourself personally in your professional life, liquidity drain is part of the ambition of the central banks in order to pull down inflation somewhat. So how is liquidity at the moment?
Well, my personal opinion is liquidity continues to contract as we speak, but the rate of contraction is actually declining. So I think the bulk of the liquidity, and remember, it was a combined monetary and fiscal liquidity injection with direct liquidity injection to Treasury, the famous checks that were sent to SMEs and households. That pandemic stimulus has been largely removed by now. And you've had a sort of round trip on asset valuation as compared with the situation before the pandemic. I think the degree to which central banks will further contract liquidity is a function of the speed at which inflation behaves better. And in this respect, I think we have good news with finally oil coming down. Commodities having come down very substantially since May, June. We are laying the grounds for better inflation number later this year and early 23.